A lot of people think that if you invest in dividend stocks, you only have to pick high yield dividend stocks. Whereas actually some of my favorite companies that pay dividends are the ones that are growing their business and growing their dividend at the same time. You may have heard of Dividend Aristocrats, and in this video we're going to be talking about the difference between dividend growers and dividend showers. And I'm also going to talk about one of my favorite dividend aristocrat companies, PepsiCo. Let's compare two stocks, the first being PepsiCo, which I would consider being a dividend grower and offers a dividend yield currently of 2.94%, while the other stock we'll be talking about is AT&T, which offers a dividend yield of 7.2%. You may be saying, well, 7% sounds a whole lot better than 3%, because if I'm investing $10,000, I'm getting $700 per year from AT&T, doing absolutely nothing in dividend income, versus only $300 investing in PepsiCo. Well, it's not that simple, because if you look at PepsiCo and look at its all-time chart, you'll see that the stock continues to go up in price, and yet the yield still kind of remains around 3% over time, because as they grow their business and their earnings, they're also increasing their dividend. Whereas if you look at AT&T's chart, it's not as pretty, as it has traded sideways for quite a number of years, but it has offered that larger dividend. But what happens with AT&T is it's not growing the business at the same pace as PepsiCo, but instead taking the cash that's being generated by the business and returning it in that higher dividend. As Peter Lynch would classify, AT&T would be a slow grower, whereas PepsiCo falls more under a stalwart. Now you may be saying, hey, don't you own both AT&T and PepsiCo? What gives? Now, everyone has a different objective, and for someone that's investing in AT&T, they may be in retirement, want cash coming out of their investments to live off of, so they're okay with not getting larger returns than the market average. They're just looking for stability and cash generation. Also, someone may be using that position as basically a pseudo bond or a pseudo cash position that they view as, okay, I want to be in AT&T versus just having a ton of cash. And then if we have a market sell-off, I'll sell off AT&T and buy growth stocks. Whereas PepsiCo is a compounding hybrid between growth and dividend growth as well. So with PepsiCo, it's more of you invest it and kind of just forget about it, because you just let it compound over time. If you're looking for these companies that have grown their dividend year over year, there's something known as the Dividend Aristocrats, which are companies that have grown their dividend for 25 years or more, and it's been consecutive, which shows that the company is having a sustainable dividend because they can pay it through recessions, expansions, any economic cycle. And then at the same time, it shows that the company is able to grow their business while also growing their dividend, which just shows that management is managing the company well. As I scroll down here, you can see there's PepsiCo, and as well at the top is AT&T, but I'll also show you something that is pretty eye-opening. If you go to dividend.com, you can see that the annualized growth for the actual dividend itself is 6% for PepsiCo, and if you look at something like the 20-year annualized growth, they have grown their dividend over 624%. Whereas if you look at AT&T, yes, they are growing their dividend and increasing it year over year, but it's not at the same pace. Over the 20-year annualized growth, you'll see 22% increase versus that 600% for PepsiCo. So not all dividend aristocrats are exactly the same. And then you may run across companies like Shell Midstream Partners that pays over 10%, around 12.6% yield. When it comes to any stock that pays a high yield, whether that's AT&T or this Shell Midstream Partners, you should look at the payout ratio, which shows basically the amount of dividends that they're paying out versus the net income. So anything over 100% means that they're paying out more in dividends than they're actually making as a company, which isn't great news, obviously, and increases the likelihood that the dividend itself gets cut at some point. You can also look at how much in dividends are getting paid out versus free cash flow, because net income sometimes does fluctuate on a yearly basis based on maybe some accounting charges that are one-offs, whether that's positive or negative. So looking at the free cash flow of $633 million for this company versus dividends getting paid out of $681 million, that's probably not sustainable either. Compare this to AT&T, which has a cash payment of $16.9 billion in dividends versus their free cash flow of $29 billion. This shows that without any accounting one-offs for the trailing 12 months, that this company actually is generating enough cash flow from the business itself to safely pay this dividend amount. Now, here's the real kicker when it comes to PepsiCo. If you look at your expected earnings per share growth over the next 5% compounded annually, it's around 9% per year. Compare this to AT&T, you'll see that the next 5 years expected earnings per share growth is only 1.39%. This tells that different story in stock appreciation, as PepsiCo has been able to grow their earnings and their dividend over time, so their chart kind of goes up and to the right, whereas AT&T, all of their profits and free cash flow that's being generated, a lot of it is going back to shareholders and isn't being reinvested for further growth of their earnings. So their earnings are growing very small, so their stock price is more likely to stay flat or slightly go up over time, but most of their returns is going to be via the dividend. And that's why for me in my portfolio, when I own AT&T, it's more of because I think the value of the stock is intrinsically undervalued. It's more of a short-term hold and not something like PepsiCo, where in my portfolio, I just have PepsiCo there and I'm just going to let it compound over time because the dividends are increasing, their earnings per share are increasing, and it's a consumer defensive company that realistically I don't see going anywhere over the next 10 to 20 years. They have a strong hold in snacks as well as drinks. So PepsiCo has been killing it. So there's no reason for me to sell a blue chip company like PepsiCo when realistically I just let that thing compound and let it grow over time. What is kind of cool is there is an ETF out there that focuses on the dividend appreciation. So if you're looking for kind of spreading out your risk across a lot of different companies and like the idea of dividend growth, you can look to something like VIG, which has a yield of 1.5%, which may not seem that high, but we have to remember that these are companies that are both growing their earnings as well as their dividends, so it should compound over time. And if you look at the max chart on VIG, you'll see the same thing similar to PepsiCo in that you kind of see both the stock appreciation as well as the yield stays kind of the same. If you look to see what are the top holdings within this fund, you'll see companies like JP Morgan, Microsoft, Johnson & Johnson, Walmart, Visa, Home Depot, a lot of companies that are well known and are considered blue chip companies. Hope you guys enjoyed the video and you learned the difference between just investing in something with a high yield versus a dividend grower like PepsiCo that compounds their dividends over time, so you get stock appreciation and higher dividends as you just hold on to the shares. If you did enjoy this video, give it a thumbs up and consider subscribing to Main Street Wolf, where we talk investing, personal finance, anything to do with money. Thanks guys for watching and have a great day.